Just do the intro like in Hebrew, and then we're going to move to English. אז אנחנו התחלנו את היום, זה דווקא, חשבתי על זה עכשיו, מטורף, שהתחלנו את היום ביזמיות וביזמים. אנחנו נסיים את היום בדארק סייד של המשקיעים. And now I'm going to move to English. And hopefully, like, because they're hosting the panel, but hopefully, like, you will ask the questions. I have like this, prepared question in my paper, but the stage is all yours. But I'm going to start with intros, and thank you so much for coming. So Raisa HaCohen, which some of you have met in the entrepreneurship course that we have, but she spoke then about her entrepreneur's journey, but now she's going to speak more about her investor journey. Raisa is managing partner at HUR Partners. She runs private early-stage portfolios for various investors, including longevity venture partners and more. And we have Aharon Zucker, which is the founding managing partner of Sapir Venture Partners, which is an early-stage focused fund, which is focused on innovative science and deep technology, and also the executive director of Mass Challenge Israel, which is still, right, the largest accelerator in the world.
Largest accelerator that takes no equity.
Oh, okay. All right, and it's like focused also on impact. I'm going to let you now introduce yourself, but I'm just going to say like the general framing of this panel is about to get like the investor perspective on the impact that technology has on society. And I think when we spoke with Tomer, which I think she's not here now anymore, but we spoke about like the role that investors have in innovation, cultivating entrepreneurs. And I think that like investors have a lot of power in general of where the money is, flowing and where they put like their investment. We're going to speak a little bit about that. But I'm doing like very, very long intros today, Nick. And I have like a tendency to speak. So we're going to start by just sharing a little bit about your journey. How did you get into this world? A little bit about your background. And yeah, Raisa, you first.
So hi, everyone. Thanks for having me here. My name's Raisa. I'm originally from the States, New Hampshire, actually. I made Aliyah about 15 years ago. And I started in high tech and venture capital, and I actually I always saw myself on the entrepreneurial side. In 2016, where I met Oded, who was running CivTech, I had a startup called CareNav. And I spoke to some of you about how I call it, kind of failing forward and don't be afraid to fail. Because I ended up closing that startup. It wasn't a lot of being an entrepreneur is being in the right place at the right time. And when I realized that those stars weren't aligned, I ended up closing it. And some of the relationships I had, I sort of transferred them over and organically sort of moved to the investor side. And I started investing for private families and private companies that each had kind of their own perspective on a specific sector that they wanted to see develop. So it happened organically, but I do consider myself an entrepreneur on the dark side. And I do try to be very helpful to entrepreneurs, even the ones that I don't fund, because I think, investors do have a lot of power, but there's a game and a rhythm to it that you don't always understand as an entrepreneur, kind of behind the curtain. I think I'll pause there, yeah?
I actually met you with CareNav. You were telling me about that. And I only just started investing then. We had the angel fund. So I'm Aaron, Aharon, depending on which country we're in. And I am now the managing director, executive director of Mass Challenge Israel. So I'm back in the light. But I'm also a venture capitalist. So yes, still sitting on that side of the table. I also made Aliyah, but I was much, much younger, so I was here ready for first grade, and started my entrepreneurial journey in high school. So it's actually Shavua Sefer. That was my first business when I was 16. I got a stand, and I got some people to let me put their books on my stand, and made it all work. Lots of little things like that I did when I was young, but definitely went to the real dark side and going to law school here at Hebrew. and practiced law for a short while, was extremely frustrated being of counsel. I wanted to build things. And I leveraged a little bit of my experience to get into a top MBA program in the US, which changed my life because I had learned how to build companies in Israel. And it's not always the best way to do things. Then we have a certain way, and I was exposed to other ways of doing business, and especially in deep tech. And so I spent about a decade building companies, 5 that I was on the founding team of, twice as CEO, and 2 of those were in biotech, the deep tech side of what we do today. And we had mixed success, like everybody. So we had some success, a lot of failure, and the successes were bigger and smaller. But I had started as an angel, right? So I made 2 quick angel investments because what I was doing, I was spending a lot of time back and forth. My time in the morning here when I wasn't working US hours, I'd be meeting with founders, entrepreneurs, just trying to see how we can help. And then I was doing the same thing in Boston. Mostly I was in Boston. Just helping people, just sitting there, spending nights and weekends with them. And that started turning into angel checks, which some people who had made money with us said, well, if you're investing, maybe you should take some of the money you made for us. That turned into an angel fund. But I was still building companies. And then in 2017, we had sold our company in Boston, and I was trying to figure out what's next, and I had no angel capital. And I went to somebody with some deeper pockets and said, I'd love to keep investing. They said, what's the next thing you're doing? I said, I don't know. They said, well, we'll give you more money if you go full-time on investing. And so I actually took a break from everything and spent 6 months mapping out the ecosystem and answering the question for myself, why do we need another early stage fund? There seemed to be a lot of capital out there, some of it smart, some of it not so smart, and where do we fit in the ecosystem? And so Sapir Venture Partners was designed around the success we found as angels. And that was that we are deep tech, Israeli focused, so they don't have to be in Israel, but they have to have an Israeli connection, either Israeli technology or Israeli founders, but they could be sitting mostly in the US, mostly the East Coast, at the earliest stages. And it has to be in a way where we can add value. So what we call it is mentorship-driven investing. We come on board to work with you, whether we're the lead and we take a board seat, whether we're the lead and we don't take a board seat, whether we're not the lead, and we're still going to be your second call, if not the first call, that you make when you have a problem, or better yet, before you have a problem and you want to talk through it. So we've been building that for the past 5 years. We are now investing at a fund 2. Hopefully you'll be soon at a fund 3. But if you're already seeing the connection to Mass Challenge, one of the biggest value adds it has is this mentorship piece. That we bring mentors and experts from all around the globe to assist the companies during the acceleration period and beyond. And I had been on the board of Mass Challenge Israel for a few years. I'd been involved since it came to Israel. I actually was involved when it started in Boston as well. And now I'm the executive director growing it here.
Great. So let's go a little bit, zoom in into your day-to-day work as an investor. And what do you look for in companies when you want to invest with them, in them? What is the things that you think makes them special and investment ready, worthy? Yeah.
Well, first, I think I learned this as an entrepreneur. You have to be in the right place at the right time. So first I look at markets. Is this the right market? Is this the right time? Is this disruption going to work? Is this sector ready to change? So first I map the markets that I like and what I think is interesting from an investment perspective. Then once I choose those markets, I sort of do a deep dive into every market, and I look at the different solutions. I pick out what I think are the best companies, and then I try to meet every single entrepreneur who's tackling that same problem. And I'm very, maybe I'm less involved in the portfolio management piece, but I'm very, very aggressive about the way I scout my entrepreneurs. I want to see everyone who's doing something in a space that I'm interested in, and then I pick what I think is, the top 1% of those entrepreneurs.
So this is why it's a fun panel, because we're the exact opposite. So the way I describe it is that we have 3 pillars to every type of company we invest in. So it's going to be market, technology, and the people. And the market, I'm willing to invest if they have 2 out of 3. I don't expect them to have 3 out of 3. I'm doing super early stage. They're going to at least be trying to figure out 1 out of 3. But when I say 2 out of 3, it means that we are not going to compromise on team. So team is first and foremost. And for us, that means, can we build that mentorship relationship? Can we actually add value? Are these people that we can sit down with and work with them? More importantly, I feel, you mentioned before about the power of venture. In 2021, investors had 0 power, right? The power was all on the side of the entrepreneur. You had 9 days to term sheet and 2 weeks to funding, ridiculous valuations. It was out of control. But in a more normal market like we're getting back to now, there seems to be a lot of power there, but I don't look at it that way. I think coming from that side of the table, the way I look at it is, I need to sell myself to them as a team member. Do they want me on their team? And I ask the question, how can I help you? I ask that question, certain portfolio companies I talk to every week, some every 2 weeks, and some that are further along, it's once a month. But in the diligence process, I tell them, the same way I'm asking you for material, the same way I'm asking you to give me a market analysis and all these other things, tell me how we can be helpful to you. Because if we can't be of value beyond writing a check, that's not us, right? So our most valuable asset is not our money, it's our time. And we want to spend it with good people doing good things. And we'll figure out the market, right? There may be no market yet. We're going to have to build an entirely new market. We're going to have to educate the market. We're not afraid of that. Technology, okay, you had one data point that worked. It was good enough to publish in Nature or Science, but now you have to build a repeatable, reliable process that you can bring to market. We'll help with that. But team is the one thing we don't compromise on.
Yeah, I think what's really interesting is the different approaches that investors have, and there are many. Some look more at markets, some look more at the people, some at the product, at the IP. I think we're gonna, or maybe if you can give one quick example of a company that you've invested in, just so we can get a little bit of the taste, and maybe even a little bit of glance of the process behind that investment decision.
Why am I always going first? So I'll talk about maybe my process is a little bit different because I'm dealing with private capital. So I outline, I help build ARC Impact's portfolio, and the investment thesis that we outlined there was finance first, high impact startups. And once we outline an investment thesis, we go into seeing, how you can build the best portfolio. BWise is our breakaway success in that portfolio. I have other ones. It's a company that's building an automated robotic beehive. And at the time, what was really interesting about it, first of all, again, was the founder, just stellar founder. The market was quite interesting because, bees are dying at an exceptional rate. It has an effect across the whole food supply chain, and really enormous effects. And from finance first, high impact perspective, it was like a perfect fit. So we ended up going in on that investment. But one thing that I always like to see in my entrepreneurs and the companies I invest in, there are two things. Because it's early stage and you're really making something from nothing, there are social proof points and then there are market proof points. So the market proof points that I like to see are customers lined up, potential customers, how you're thinking about building out your market, and how you're thinking about commercializing your product. So what the entrepreneur there had did in his data room where he was building out things, he basically had 300 potential customers lined up that said, when you build this product at such and such a price, I'm willing to buy it. And so he had this incredible pipeline lined up of customers, which really spoke to me in that, one, he really thought through his commercialization process, but two, wow, I don't know anything about bees. I'm educating myself, and it looks like these market proof points, there's got to be something there. So I'll stop there.
I knew she was going to pick BeeWise. BeeWise is the only company in my anti-portfolio. Do you know what an anti-portfolio is? Anti-portfolio is a list of companies that you didn't invest in that you missed, right? So there's very big name VCs that have Facebook in their anti-portfolio because they told Mark Zuckerberg, no way. So BeeWise is the only company in my anti-portfolio because I was Sal's mentor at Mass Challenge. I worked with him for 4 months. Loved the passion, loved what they were doing, helped them figure out some of the market validation you're talking about, and taught myself a very, very, very important lesson. A, humility, and B, ego should get out of the way, and that finances don't matter. Meaning, we could have been in on that deal, and we didn't for the wrong reasons. And that's why we're doubling down on people, and we should have done that investment. But the example I will give is actually a company called Tomorrow.io. So Tomorrow.io used to be Climacell. They are a perfect example for what we try to do as Sapir, because they were actually one of the companies we did as an angel. They were 3 Israelis in the US sitting at Harvard and MIT and decided instead of going and get an internship in their summer between their 2 years at school was to try and build their own company. And they were going out to solve the problem of weather data, which we don't have good enough weather data. And they came from different reasons that they needed it. And I started spending time with them. It was just like somebody made an intro, we sat on a panel together. I don't remember exactly that piece, which one went first. But then I started meeting with them. And when I was in town in Boston, I'd spend hours with them. I'd go there, that's where my nights and weekends were. And I'd help them figure it out. How to go to market, pricing, dealing, to the level of let's draft an email together, right? To how to figure these things out. And it also taught us that even though these 3 founders who are amazing founders, and if you think about them, even by Israeli standards, they stand out, right? So pilots and Sayeret Matkal and all these other, they have the credentials, Harvard, MIT. They still had significant challenges as Israeli founders to bridge the culture gap of doing business in the US. And we were able to help be that bridge. So much so that Shimon, this is a story, at least the way I tell it, I don't know, he probably tells it differently, but the way I tell it is that Shimon called me one night, midnight Israel time, and he's like, I have a problem, can we talk? I'm like, sure. He says, I have 3 term sheets, I don't know what to do. I said, that's not a problem, you just called to brag. That's great, you got 3 term sheets. He said, no, it's a real problem. Because he had a term sheet from a very big brand name fund, but they didn't like the partner that was leading the deal. And he would come on their board. They had a term sheet from a new and up-and-coming fund that they loved the partner, but they didn't have the brand. They didn't know if they'd even be there in 5 years from now, or 3 years from now, or 2 years from now when they needed help raising. Or they had a bunch of angels that were strategic and could actually help them, but they were angels. So he didn't know what to do. I said, I can't tell you what to do. Let's talk through it. We talked for about an hour. 3 days later, I get a signed term sheet in my inbox. Shimon saying, thank you for all the help you've given us getting to this point. We want you in this round. We don't care how much you can do. Thank God I wrote that check. That company is doing really, really well. They canceled the SPAC. That would have put them at over $1 billion valuation. That would have been our first official unicorn. But they're doing pretty well, and soon some new announcements will come out soon. But that's what we're trying to do with Sapir, right? So we actually took that experience, and we're trying to replicate it with every company in the Sapir portfolio.
So you talk now about the $1 billion valuation. We talked, I think, and I think the next question, and then I think we're going to transition to the more grand theme of this program of MATAR. That your job as an investor is obviously to make financial profits and to think of the dollar sign at the end of the day. But there is also the impact component, and you're both specifically also driven by it. I think not like as many other investors. Like there is like a spectrum of investors that are a little bit more tended toward impact and a little bit less. What's the balance between optimizing for profit and optimizing for impact?
So this is one that I constantly struggle with. With ARC Impact's investment thesis, it was finance first, high impact. So first and foremost, they had to be viable, venture-backable companies, okay? That means that downstream, if I don't have investors that are gonna pick up my, company for Series A, B, C, the companies are dead in the water. And there are plenty of companies that are good companies, sustainable companies doing important work, but they're gonna have linear growth. And what we're looking for in venture capital is exponential growth. And you can't really be a cowboy in venture capital. If there were more impact dollars downstream, it would be much easier to do a lot more sort of high impact, financially sustainable investing in a responsible way. But that's not how the ecosystem is currently built. Now, I think venture capitalists are paying more attention to impact, and I do think that the current major problems that face society are all related to impact. So you can't really ignore it. But for me personally, what it means is I only look at what I call sectors of impact. If this is not an impactful sector, if it's not healthcare or aging tech or ed tech or med tech, if it's cyber, great, but not for me. That's not where I want to allocate my investment capital. So I look at sectors of impact, it's a challenge because the impact investors, you can make a be-wise investment and you go to the investment committee and they say, but this is not helping, emerging markets in Africa. This is not helping real vulnerable populations. So you can kind of, to dance that fine line, it's a very delicate dance. And it would be much easier to do if there were more impact investors in the ecosystem. But the reality is they're not. And so you have to look downstream and say, look, is traditional venture capital going to pick this up? Are there generalist funds? Are there specialist funds that are going to be gonna come and look and see this as a potential investment? If the answer is no, then it's not a venture-backable company, and then it's not fair to my shareholders to take a serious look at it.
I think you're touching on a really important point because it's how you define impact, right? And that gets very fuzzy for a lot of people, especially impact investors. You're actually one who is always very, very clear on what it means. You define, like you said, the sector, and you're going to try and make a difference there. There are many others that define themselves as impact investors, and I ask them, well, what does that mean? Or I'll show them a portfolio company that can save lives, that can transform, food. And they're like, no, that's not impact. But what is impact? And it's a tough question, and I answer it very, very broadly. So as Sapir, we have an advantage being deep tech and really, cutting edge science that we're trying to bring out of the lab. They're most probably going to have a meaningful impact, right? It may not be as clear, and there may not be a market yet, but that's kind of how we hedge. But if I can, I want to answer actually from the Mass Challenge perspective. So Mass Challenge, when we train our judges on how to evaluate, so you have 3 rounds of judging at different points of time throughout the program to get in and then to graduate. And we tell them to check 2 things, impact and viability. So viability is what you're talking about, that they can actually succeed and sustain themselves and grow, and there's the potential to be a real company, but that they'll also do impact. And the judges always ask, well, what does that mean? And we say, it could be anything. You define what impact is. And the way I described it, yesterday I had the privilege of talking to the senior global management of a Fortune 50 company. And they're trying to figure out how to solve for innovation and things like that, and that was in the Mass Challenge hat. And I told them a story that we did in business school. When the new dean came in, he created a student advisory board. And he took us into the fancy conference room with the dean's office, and we sat there, and he put up all the different mission statements of the top business schools. And he said to us, what's the difference between ours and all of theirs? And the one thing that was missing, everybody talked about leadership and change and management and impact. Nobody ever said good or positive except for us. So we've kind of looked at the impact as how do we do good in the world? And do good in the world, and that's what I tell judges at Mass Challenge, if all we end up doing is create a team of founders, 2, 3 people who are now going to be millionaires or mega millionaires because they had an amazing exit, and they can now fund other entrepreneurs, become angels, can bring from their experience, can create jobs and drive the economy, that's impact. And to me, that's positive impact. So we're very broad on that.
Yeah, I think you touched a very important point that, defining impact. I mentioned to Tomer in a conversation that we had before, and actually Brian, that's supposed to be coming to this panel, couldn't join for personal reasons, and he hosted a fireside chat on Zoom with a partner at USV a few months ago. USV is one of the biggest venture firms in the US, and they were the early investors at Twitter. And he also talked about impact, how do you see impact and all that, and he was very honestly say, listen, it all depends how do you define Twitter. It's good impact, bad impact. Yeah. I actually want to open it up. I have a few more questions, but I want to open it up for the students, if you want. Yep. אפשר גם לשאול בעברית, if you want. And, yeah. Yep.
This question is more towards Raissa, but Aharon, you could answer as well. Yeah. You said you scout aggressively. Once you find a sector that you're interested in, you scout that sector, hoping to find entrepreneurs. And so, how is the scout process? What do you do? And once you find a list of entrepreneurs, how do you choose between them?
So first of all, there's a lot of research involved. I'm constantly doing research and scouring specific sectors for any companies that I think are interesting. Also, I think in venture, your network is your greatest asset. So there are a lot of co-investors that, maybe it's not for Oded, he sends me stuff, I send him stuff, same. We all, look at similar things. I will say that I aggressively scout on LinkedIn. I found my last investment, I reached out to him on LinkedIn, and the second I reach out to an entrepreneur, it's theirs to lose. Because I know I like the market, I know their solution is interesting, I just have to get sold that this is the best team that I'm looking for. And I've often been offered, analysts and secretaries and someone to help me with my due diligence. I like to own that process because every interaction is a data point for me. If you can't stay at the top of my inbox, if you can't engage and build a meaningful relationship over LinkedIn or over email, then it's probably not for me. I do, like Aharon said, I do like to build a strong relationship with my entrepreneurs. My added value is not, I don't have the experience that Aharon has in, building and running companies. I know more about the fundraising process and, who to put in a round and who could be potentially for the next round. But I would say that 80% of the deal flow gets dropped in that initial communication process. Either it's sloppy or a lot of people just don't show up. And honestly, there's a company that I really liked in the robotics space, and they didn't follow up. I was ready to write them a check. And often, to me, it says something about I'm on top of my inbox. I consider myself an entrepreneur. Entrepreneurs don't miss opportunities, and every interaction is an opportunity. So those are the types of personalities that I'm looking for, and they're pretty hard to find, and they tend to funnel themselves. So that's a decent answer.
It's you asked specifically about scouting, but just to double down on that piece, my father-in-law, who's a relatively successful businessman, not in tech, says time kills all deals, and that goes straight to what you're saying, right? So he taught me that early on. If you're not moving when you have momentum, it's just gonna phase out. But that really wasn't a question about scouting. So.
No, but that's true. That I do find the best entrepreneurs demonstrate a sense of urgency, because in venture capital, it's not just investment. We're investing over time. It's how quickly you can grow, how quickly you can return that investment. That reflects on me and my portfolio. So the entrepreneurs that do demonstrate a sense of urgency, those are the ones that I'm looking for.
No?
I have a question for both of you. Besides being communicative and having this sense of urgency, what would be the best advice for entrepreneurs that you would give?
I would say not just find something you're passionate about. Find something you're obsessed with. Find something that keeps you up at night, that drives you. When I had CareNav, it came from a very personal story that drove me to build what I thought was a very interesting solution to a problem that I personally had, but happening on a much larger scale. And so what I would say is, you have to be talented, but obsession beats talent every time. So I've never found anything that, I always said that, I love being on the investor side, and I would love to go back to the entrepreneurial side. I've never found something that's driven me the way that my, first company drove me. And so I would say, find something that you just live and breathe.
So, I could spend hours trying to talk about this and answer that question, and I still wouldn't cover everything you need to know. So just to add a little bit to that, we call it mission-driven, right? So the mission-driven, this passion around it, but also the ability to create a vision, right? So tell me what the world is going to look like if you succeed. Get me on board. And when we dig down into what that means in your elevator pitch, your bigger pitch, your marketing materials, how you engage, it's all the time you're creating these little hooks that might grab an investor's attention for whatever reason, because you never know what they're thinking and where they're coming from. And if you throw out these little tidbits along the way, one of them may really resonate. And so being visionary about what the world could look like, assuming this all goes well, right? There are a lot of investors that will look at an opportunity and try and tell you why it's not going to work. But most investors, especially people who are coming from the entrepreneurial side, they know what you've been through. They're like that. In many ways, I love Sapir because I'm entrepreneurial. I'm building a new fund. I'm building a brand. I'm creating something new, and I'm still building, but I'm also on the investment side and helping others. So what am I helping them do? I'm helping them achieve that vision. So I'm looking for that. And I think a lot of us from that side of the table are looking for that. How can we help you achieve that? And is it worthwhile trying to achieve it?
שאלות?
So you talked a lot about the people, that you're looking at the people and the team. I was wondering how much do you look at like passion and stuff like that are more soft, and the team as a professions is like, if I have a CTO, a designer, and the CEO, I don't know if you have the whole things that a team needs to have to actually build it, like if that's a really important thing, or is it enough to have a base without the technology, all the technology covered and.
You're asking me or Raisa? All right. Okay, so I will actually go first once. I'm still a gentleman, I'm sure, I hope. It's a good question, right? Because the way we described 3 pillars or the 3 legs of the stool, where we're willing to be flexible with 2, we're not flexible with team. And you, if I were to break up your question, we're asking 2 separate things. So one is about the passion and one is about the completion of the team. So passion, obviously, everybody has to be on board, right? There's no question, that's what we were talking about in the previous question. But you don't have to have the perfect team. What you do need to have is the components of the team that you need in order to achieve the next 1 or 2 steps that you're raising money from me now to achieve. So if you're already at a stage that you need to go to market, but there's nobody on your team who's done biz dev, who comes from the industry, who can talk to your customers, then we have a problem. If the CEO can do that, wonderful. and maybe they'll bring somebody on afterwards. That's fine. If you're at super early and you're doing R&D and there's nobody who can lead the science, then we have a problem. And we've seen those. We've seen really innovative people who are coming with amazing ideas, but they have nobody on their team who can actually build what they want to build. We're going to find them. Okay, find them and come back. Right? Then we know that there's something here to invest in. So it doesn't have to be a complete team. And this comes from my personal experience as well. So I'll share it as a story, as an example. When I joined Gen 9, I was the only business person on the team. And that means I did everything you could think of, including taking out the trash, but everything. And I had to build models, and in biotech, I don't know how to do that. But I had to learn very quickly. But I also had to be the CFO, and I also had to be the COO, and I had to be the sales, and I had to be biz dev, and I was raising money. I had to do everything. And that's a great experience. But very quickly, I had to start hiring people as we were moving along who could do it much better than me. So a COO, a VP R&D who can now take the whole COGS analysis from them and how to run that side of operations. We had an admin doing HR stuff and helping with the financials. Eventually you hire a CFO, an internal counsel. When we hired our lawyer and we brought her in-house, that's when I realized I didn't really have much to do anymore because we really had handed off everything at that point, sales and marketing. But you're going to naturally grow. The question is, do you have the team you need now to execute on your vision, or do you know where to get them?
I would just add that I think I've had one or two. First of all, being a solopreneur is very lonely, and it's a big challenge. And startups are very stressful. So I would also focus on, relationships. There are teams that come to me that they've known each other for 3 months, and I'm very wary of whether they can handle the pressure together. It's a marriage. And I love the story of, we came out of the army together, we were at university together, we've known each other for a long time. It's like that you've been through ups and downs and you've dealt with pressure together and you can rely on each other. So I think that relationship piece is important as well.
So we've seen the market lately go a little bit into recession right now. Are you more conservative with your money? Do you think twice, 3 times, 4 times before you invest in a company now? In regard to the past future, past.
Where did someone blast that?
So first of all, one of the lovely phenomenon in dealing with private capital is that you don't have an IRR ticking. I'm not pressured to invest a certain amount over a certain amount of time. So I can pass on any deal in the top 10% until I get a deal that I feel like is in the top 1%. So that hasn't changed at all. What has changed is over the past year, and Aaron alluded to this, is that there were deals coming that were raising at incredible valuations with really not much more than an idea. And those I anyway passed on. So it doesn't affect my ability to invest much, but I will say that I am glad to see valuations coming back to reality, because I do like to see those, when I mention those market proof points and those social proof points, before I invest. And so I would anyway never invest in a team with an idea. So I'm glad to see that there's a little bit more progress and a little more time to get to know entrepreneurs and do proper due diligence.
I first want to make a slight correction. It's not my money. And I actually take that very, very seriously. I am managing other people's money. They've worked very hard to make it. And the one thing I can't do is lose it. Hopefully I'll also make money and we'll all be happy. But with that perspective, I actually did not write any new checks in 2021. I wrote follow-on checks, or we helped our founders raise, and so our LPs may have invested directly in things like that, but I wrote no new checks in 2021. The valuations were out of control. Things made no sense. People were not building business fundamentals. They were just rushing to get the next check in. These are not stable companies you want to be backing. Now, in 2022, we are way more active again. We have several. We have 3 going up to the investment committee that hopefully may still even close before the end of the quarter. Probably not, July. But we're moving much more quickly today. So as Raisa said, the valuations have come down, but it also has required companies to build, the founders to build companies the way they're supposed to be built. I've always been a very, I don't want to say strong, but I've given my share of perspective on the way Silicon Valley builds unicorns. The idea of, we're going to hit a valuation, so give us the metrics on that valuation already at this round, and then when we don't hit it, we'll explain to you why, but give you even greater valuation metrics, and then you should evaluate us on those. You're always trying to backfill value, which is very hard to do. And so we're coming back to a world where, okay, what is your ARR? Okay, so now we'll give you a multiple. The multiple will no longer be 45x, which was 2021, which it shouldn't have been. It'll be somewhere between 5 to 10x because we believe there's reasonable growth between now and the next round, and you'll fill that up and you'll get at the low end to 5, at the high end to 10. If you exceed that, great, you'll have a higher valuation for the next round. And I don't do a lot of SaaS, so that's just a quick SaaS example, but that is a lot easier to manage. And the truth of the matter is that there's a lot of uncertainty in the market, a lot still. So even though the valuations are tough, I think for the founders, I think it's a better time to be building a company. Same way it was in 2008, 9, 10. Same way it was in 2001, 2001, 2002. These are the times to be starting and building and focused on fundamentals, gaining traction with customers, being a little bit more humble on valuation, and overall, startup costs are lower, so you can manage with a little bit less capital, and you can build a very strong company that will be positioned to ride that growth when we come out of this.
So I have 2 questions. First one, you said something about being in the right time, the right place. Do you ever call back someone after, when it's the right time? And also, do you think that it's your job to combine, maybe from your point of view, combine companies and ideas, like mix them, so just cooperation?
So it's combining companies and? So first of all, the answer is yes. I go back to companies all the time. I like to see progress over time. It's not just when you're investment ready. Because I will tell an entrepreneur, look, I really like what you're doing. I like this, I like that. Here are the 2 things that I'm missing. And if I had these 2, market proof points, I would bring it to the investment committee. So I do like to see data over time, because that shows me progress and it also shows me grit. So I go back to companies all the time. The second was combining. Probably Aharon has more experience, but the entrepreneurs that I generally look at have a pretty singular vision. If they know that they're missing something specific, I'm a CTO, I'm missing a CEO, I definitely, I love matchmaking, I love, trying to bring the first 10 employees into a company, because they all kind of have to be generalists and entrepreneurs at the same time. But I've never successfully combined, 2 companies in a space.
So I'll start with that and then go to going back. My venture partner, Yossi Tzuria, was one of the founders of NDS, Cinemedia, used to be the biggest exit in Yerushalayim till Mobileye. And he totally believes in that, right? Because we keep seeing founders who are solving a part of the problem. And they may have a very good reason for going after that part. When we started Gen 9, we did the same thing. We were starting with the DNA, even though the whole design process in bio was complicated. And synthetic biology was supposed to change and revolutionize it all, but where do you start? There was another company called Genome Compiler that was here in Tel Aviv. They started from the software side, just designing the DNA parts and how they connect. We were actually building physical DNA, much more expensive, much more complicated. But really, we should have combined, and we did actually try to buy them, and Twist bought them instead. But we do believe in that, and so Yossi keeps saying, we need to just raise a fund that will find the strongest team solving in this space, and then give them enough money to go and buy 2 or 3 others, pull them in. But really, that's a private equity fund. And it needs a lot of capital, and it needs a different type of investor. It needs a more of an operator type investor that can bring that team together. You're going to spend a lot of time on HR making that all happen, right? M&A is hard. Most M&A fails, especially around culture. So we do like that. We've never done it. We look at things like that because what we do is that we engage across the portfolio. We are constantly making connections across the portfolio of either companies that can help each other or can work together. So much so that in Fund 2, we brought in 3 founders who were early investments that have gotten a lot of traction and made progress. We've brought them in as small equity partners in the fund to be advisors to the new investments that we make into new companies and help them kind of network and maybe grow in parallel. So we do believe in it. It's just finding the right way to do it, or a lot of capital to be able to really do what you were describing. I think as coming back to your first question around going back, I wish I could. I don't have enough time. I don't go back. And I should. I should. Thank God we've built a very nice brand that they come back to us for the most part. So whenever they do, I kind of am hesitant because it means that they couldn't get money anywhere else and it's been 6 or 12 months and what was going on. But often they will have done exactly what you're describing where they've overcome some of the challenges we saw early and passed on. We're able to solve for them and now we're in a very different position and we can reevaluate. And so this brand of being helpful, we also try to respond. I try to respond to every email. We try to be helpful to as many as we can. Yes, my inbox is ridiculous, but that's what allows people to come to us. So that's the best source of deal flow to your question about sourcing, and it's also what gets people to come back. What do you guys do? I'm actually curious.
So we have a watch list that like we try to keep track on. We're a very small fund, but yeah, we try to do it. Obviously, we I think, Spot and Mark, the company that we especially, like or got impressed with, and we actually build a system of reminding because we don't have time and capacity and everything. So we just, build reminders to each, for 2 months, 3 months time to get back to them, see where they are. But I think in general, it's more on the entrepreneur to go back to us. And when an investor says no, so sometimes it's a no, but sometimes you have to be, and there is a fine balance, I think, of, going back and lo latzik, but again, don't be shy. So it's a fine balance. And also it depends on the vibe and energies that you have with the investor in the sense whether, it's a no or it's a no, but maybe I'm going to come, in a few months' time with more traction, more, whatever, more polished deck to talk again. And we invested in companies that, came to us after a few months and, with something else. We also to invest, I think I shared it with the course of this blog post by Mark Schuster of investing in lines, not in dots. So you like to see the progress over time of the company. But yeah, it's always, and you always, I think, also miss because you said no and you forgot about it and yeah.
I'll add to that just because our model is a little bit different. We actually will work with them in that process. Meaning when we're building that mentorship relationship, if, first of all, a no is a no. Until it's a yes, it's a no matter what they added after the no. But if we see potential, we will actually work with them. It's not come back to me in 3 months. It's, okay, here's feedback. Let's schedule a time, let's walk through your deck. Let's schedule a time and ask questions about your market. Let's schedule a time and bring an expert in to help you advise you on your R&D plan so you could figure this out. And if we become part of the process, and that is actually our diligence process. So for us to say no, it's no. If we say, how can we help? Then that means we're already engaged and we're going to figure out. It may lead to a check, it may not. And for some of these companies we work with, it could take even 8 to 10 months. But we're part of that process when there's enough there.
If not, a dystopian question.
No, not the dystopian question. The question is, suppose there are folks in this room today who hear your side and think, wow, I'm really interested in sitting on this side of the table, on the side of the funders, and being in this position of understanding what's going on in the market and this sort of process of discovery that you guys get to do. What's your advice for somebody who's now second, third year undergraduate? What's the path that they can take to eventually be sitting where you're sitting today?
Fresh.fund has a course called, called the Investors Course. Noam took it this year. Raisa taught it last year. Aharon was a guest speaker.
Look, my path was not traditional. I sort of started on the entrepreneurial side, and then I worked with private investors and sort of built up my own name, and I had some successes, and that sort of snowballed. I think the traditional venture capital path of, intern, analyst, associate, there's not necessarily the growth path that you would want. Necessarily, a lot of the partners that come in have successful exits or they're successful operators. There's not necessarily that, corporate ladder growth path. And I think Sheryl Sandberg says, there's no longer a corporate ladder, it's a corporate jungle gym. So I think you have to, scout opportunities where you see them. Sometimes it's taking courses. Again, this industry is very, very relationship-based. So I would say try to follow thought leaders that you think are doing interesting things and build relationships with them and go after it that way. Again, my path was not traditional. I didn't go through a venture fund, and I think the path to the growth that I was looking for wouldn't have been answered.
It's true. I mean, I think it's very hard in large, to get a job at a large fund, because they're not that large people-wise, even though they might be large capital-wise. But it's very, very hard to go up the ranks from analyst to senior, to associate, senior associate, principal, vice president, partner, managing partner. It almost never happens. The irony is that the guy who gave me the best advice, Scott Tobin over at Battery in 2008, said to me, just go get operational experience. You'll be such a better investor because of that. And I agree, he's 100% correct, but he actually started as an analyst at Battery and now is the chair of the firm. So it's for every outlier, it actually proves the rule. And I would definitely encourage you to do that. Now, there are people who know they really want to be on this side of the table, that they actually build a career that, I like the jungle gym analysis, because you're bouncing back and forth, right? So you'll go spend a couple of years at a fund in a very junior role, but really learn how to evaluate a market and an opportunity, but then use those tools to go and figure out a company either you want to join or maybe start yourself. Ideally you join, because it's not your first rodeo and that you already have to be CEO, and you learn some experience there, and then you come back to maybe a different firm, and you get some experience at the mid-tier level. Now you're already kind of getting board access, you're seeing there, you're not on the board itself, but you're sitting there as an observer or getting that second tier. Now go do your own company, hopefully have your $1 billion success, and come back as a fund manager and investor. That to me seems like a really strong path, but yeah, there's no rules to the game. If you're interested, it's all about networking. Just keep talking to people and be smart enough to grab an opportunity that opens up along the way.
All right, I think we need to wrap up in a few minutes. So I'm just going to ask the last question that I ask in every panel or guest speaker that I bring to my course. And it's about your recommended reading, listening, watching, actually related also to Katrina's question. What people do you follow? What do you recommend for the students to read to be in the loop of everything?
Danny Warshay just published a book called See, Solve, Scale. And that's sort of, he was a professor of mine at Brown, and that's kind of his methodology to viewing entrepreneurship. said anyone can be an entrepreneur. This is kind of the pattern and the rules of the game. So I would definitely highly recommend his book. I also, Barry Nailbuff was he's a professor at Yale and a guest lecturer in my course. And he actually has a Coursera course that's quite good. It's about the art of negotiation. And I think it's called Slice of the Pie, his latest book. But his theory about negotiation is it doesn't always have to be a zero-sum game. And everyone is bringing their own, you're not just a check writer, you're bringing your value, and the entrepreneur is bringing their value, and together you can create something stronger than you could alone. So I think his perspective is very powerful as well.
So I'll give a plug for Bill Allett, who is the managing director of the MIT Martin Trust Center for Entrepreneurship. He wrote a book called Disciplined Entrepreneurship, and I think in this environment today, discipline is really important. If last year we had to be disciplined as investors, this year founders have to be disciplined in how they build their companies. So Disciplined Entrepreneurship, it really is a step guide on how to build a company, whether venture-backed or not. And so I think that's a great book. Podcasts, there's the usual suspects. If you really want to understand how venture works, Samir Kaji has been a mentor of mine. He's got Venture Unlocked, which is a great one. There's a couple of others, 20-Minute VC, right? That's a great example of how to become a VC even though you've done nothing. Like, guy's 20 years old, he started a podcast, was interviewing VCs, he barely graduated out of college and he's already a VC. Because he just interviewed hundreds of VCs, of investors and founders, and learned the business that way. So there's no one path or clear path on how to become a venture capitalist. I would also suggest, the usual suspects are sometimes not who you would actually suspect as far as blogs go. So, you could go to the big name VCs, but there are some of the smaller homebrew, who's the other one I'm thinking of? So there are a few others of the smaller VCs that are willing to share more because there's no longer this black box of venture capital the way the big old firms used to work. It's way more open, and they're sharing some very deep analysis and their thought perspective. But one thing I would say for all of these podcasts and blog posts, that's one data point, right? That's one perspective. And there's a lot out there, and finding the right fit for you is just as important.
I think that's a great ending point. Thank you so much for joining us. תודה רבה על כל השאלות.
אני חושב שאני וקטרינה רוצים להודות לעודד. הארגון של היום הזה הולך משהו כזה, אני וקטרינה נפגשים ואומרים יאללה, מה עודד יכול לעשות? אז הוא עושה את ההתחלה ואת הסוף, ואנחנו עושים איזה משהו באמצע. תודה רבה לקטרינה. תודה לאורחים שלנו. אתם מוזמנים לאכול ולפטפט. And we'll see you next semester.
Thanks, Nick.